Hello everyone. Today we will discuss about company analysis. Company analysis comes under fundamental analysis. Fundamental analysis under that two things will be there: company analysis and technical analysis. First, what I want to see, if something I am buying, I have to see what I am buying. I have to see the value. So in fundamental analysis, they will ask you where to invest. You should know the value. How you will do the value investing. For that, you should know only this. You want to know कि whatever stock I am buying, for that intrinsic value, you should know कि it should be intrinsic value. It is higher than the intrinsic value or lower than the intrinsic value. So you should know it is undervalued or overvalued. So these all things comes under the stock market. For any business, if you are putting money, either it is a business or your any kind of thing you have to buy, or you are going for some services, or you are buying some vehicle. So that time you have to see ki if I am paying that amount that is worth for it or not. That is the meaning of value. Value means whatever you pay that is a worthful or not. Means if you buy something or if you got something, you are satisfied or not. If you are satisfied means it's a worthful. So that is a value. So again the same thing. If you are buying something, talk. So what you are thinking? The value of the, for example, if I am buying a stock gold, what I am thinking, today the gold price is 60,000, 10 gram. So if I am paying 60,000 and I am getting the gold, how I will know it is a costly or it is a not costly? Because why you know this is worthful? Because you know it is universally same. Everywhere gold value is same, so it is a worthful. So these things will come under the fundamental analysis. For example, property valuation. When we are doing, if I am buying some property for 1 crore, how I will know if this is worthful or not? So based on the location, based on the real estate, I will check it is a worthful or not. Based on the place, based on the location, based on your what are the comfortability you want, what are the area, what are the external things you are getting. So these things will be matter when you are buying a flat, when you are buying any property in real estate. So then you are seeing, then it is a value. Means whatever you are buying, you know, it is very useful or it's a worthful. Whatever I am paying the amount. So that is your value. These things is very important in fundamental analysis. First, we should know about the company analysis. Then we will know about the technical analysis. So in the fundamental analysis, in company analysis, I will talk about today, and the next video I will make for the technical analysis. So here my outline is the study of financial record. There I gave some example for anything you have some value, and that value means what? Whatever you're paying, it is worthful or not. So here again it is what I will discuss going beyond the numbers, definition of intrinsic value. I just talk about key intrinsic value to be higher or lower, tools for judging undervaluation or overvaluation, obstacles in the way of an analyst, and equity research in India. See, study of financials. What is the thing? The key question in the addressing applying the earning multiplier approach, the most popular method in the practice. What is the expected EPS, earning per share? What is the PE ratio? I want to know these two ratio. What is the debt equity ratio? These three ratio is very important when you are buying any stock for any company. So here I should know about the three things: EPS, PE ratio, and debt equity ratio. Then only you will know about the intrinsic value because it is a part of the fundamental analysis. See, what is the expected EPS for the forthcoming year? What is the reasonable PE ratio? I told that. So if you want to invest for any stock for any company, that time you have to see the company's financial uh, analysis. You have to see that what is EPS, then PE ratio and debt equity ratio. So first I should know about the what is intrinsic value also. If the price today whatever is there, if the price, see that if you want to want to buy any stock, you see first intrinsic value. What is that? The whatever the price today, the intrinsic, it is a less than intrinsic value or more. If it is a less than intrinsic value, means it is done. You have to buy that stock. So first you should know about the intrinsic value. It should be always less than the price. So here the answer these questions, investment analysis, the historical, earning, growth, risk. See, I don't want to confuse while saying that it is a ratio analysis, because three ratio is very important. First, you know the earning per ratio. Then P ratio, that is a price earning ratio, is very important. And third is debt equity ratio. Don't be confused while seeing the mini ratio, because mini ratio is not at all required while seeing the buying the stock. And one is PB ratio is important, price to book value ratio. So these things are very important. Your EP ratio, EPS, earning per share, your PE ratio, price earning ratio, your PB ratio, price to book value ratio, and what is your debt equity ratio. Sometimes we are seeing the current ratio and liquidity ratio. Why current ratio? Current ratio is simple. Your current asset over the current liability. When the company is buying, when you know what is the current ratio, that is always it will be 2 is to 1. Whatever the company having equity and the debt, that the ratio will be 2 is to 1. See, so earning and dividend level, what? To access the earning and dividend level, investment analysis include the metrics, that is return to equity ROE, book value per share, that I told, PV ratio, what is the price book value, what is the earning per share, EPS, what is DP ratio, dividend payout ratio, and dividend per share. For example, financial, if I am taking for any company, here the example for the Tata, what is their net sale, what is the cost, all these things, why I wrote this, because end of the day here it is written, what is your P ratio. So here PE ratio, your EPS is earning per share. What is that? Your total earning divided by number of share outstanding. That is your EPS. ROE. What is ROE? Ki whatever your PAT sales asset by sales this value. See, ROE is written on equity. Previous video also I had discussed about that. So book value per share and earnings per share. This is very important. Book value per share, how to calculate? Paid up equity capital divided plus your reserve and surplus and number of equity shares. So you should calculate by using this formula, and EPS is your total earning divided by number of share outstanding. So these thing is very important. If you are buying some stock, means you are paying for to the some company, and if you are paying 10 rupees to the buying that share, means you are paying how much? 10 rupees for buying one share. For one share you are paying to the company, that is 10 rupees, means their P ratio will be what? 1 is to 10. So that is all depends. So these formulas, book value share and earnings share, how to calculate. Dividend payout ratio, DP ratio and DPS. Dividend payout ratio is very important. Ki how much company is paying dividend from their earnings. So that is your dividend payout ratio, ki your equity dividend by number of equity share, whatever the earning. And DPS, how? Your MPS by EPS. So these things you are, if you have any companies balance sheet and income statement, if you have an income statement, you are able to calculate their EPS, PE ratio, DP ratio, DPS, price to book value ratio, current ratio, and intrinsic value. So this is very important. If the your PB ratio will be more, if it is, then you should not buy, because if more PB ratio is there and your less your book value, then don't buy that share. Sometimes it is happening. Book value will be not much, but your price will be much. So that time we have to see other factors. So that time we are seeing debt to equity ratio. Okay, what is the company have debt and how much is the equity? Okay. So debt to equity means debt divided by your equity. Debt by equity. That's why we can say debt to equity. Company getting the money from two ways. Either they have loan, either they are selling their shares and buy. So growth performance, how to measure? The company's annual growth rate, CAGR, like sales, net profit, EPS, DPS, all I discussed here. So how to calculate compound annual growth rate? By using these formulas. So sustainable growth rate ki how we are getting the retention ratio and return on equity. So company's debt equity ratio is very important. Ki how the company will get the money if they want to further investment. So the company will buy from the equity they will invest or they will get the debt. So the company will prefer sometime loan. Why? Because that is easy. Because we have to repay. Some company are very confident. So they are not selling their equity. They are they are getting the loan. For example, I will take for the Zerodha. Zerodha, now it is a growth oriented. So Nitin Kamath has think that if I have to growth, I will not sell my equity. I will take loan. Because they had having a confidence, they are very new, but they had a confidence. Because that is not wrong. Because if you are taking the debt, you should have a capacity to repay the loan. Either it is a Zerodha, because why? Because personally I am trading in Zerodha, that is a kite app. That is very easy to buy, sell, and the brokerage is also less. And it is your mobile friendly. So you are able to use it. So that's why I gave the example for Zerodha. Risk exposure. See, so for that beta is your volatility that I will discuss in next class. Ki how the beta will affect risk, volatility of return on equity. So range of the return on equity over an year and what is the average return on equity over an year. So these are the favorable and unfavorable factor. The favorable factor, if EPS level, what higher the book value. Just I discussed favorable factor, unfavorable factor. For the like earning levels here, high book value per share and unfavorable low book value per share, EPS. See, this video is little long, please, but see till last. Because you should know EPS, when the price book value I told about, but EPS always should be high, that will be the favorable. And the low, it will be unfavorable. Growth level equity is high return on equity and again low return on is unfavorable. Same thing if your EPS and growth rate, if you see that we are seeing the high sustain. Just I told about, if the company is growth oriented and they have a confidence on themselves. For example, Tata also, they are taking loan because they know that I am having a capacity to repay the loan. So always you should know, but the debt equity ratio, how you will measure? Always debt equity ratio should be less. You should know that their repaying capacity is there or not. For that, if you want to measure the debt equity ratio, you have to measure two ratio, current ratio and liquidity ratio. What is current ratio? I told current asset by current liability. You see, always it should be 2:1 is favorable. That is the company is able to do or not. Second, liquidity ratio. What is liquidity ratio? Current asset minus inventory divided by current liability, or liquidity ratio is that, or liquidity asset by current liability. Then that is equal to always 1:1. So the company, what is the, if company is having 20 lakhs equity and 10 lakhs liability, so we know it is a ratio is 2:1. So it is, we can say higher the current ratio, that is more favorable. But liquidity ratio is already, it should be equal. Then PE ratio, जितना अधिक कम होगा, that is PV ratio is ideal. So risk exposure is what? Low volatility, return on equity and high volatility of return equity. So current ratio already you know now. जितना ज्यादा होगा उतना ज्यादा अच्छा है. लिक्विडिटी रेशियो इक्वल होना चाहिए. पी रेशियो कम होना चाहिए. अगर आप ईपीएस देख रहे हो तो ज्यादा होना चाहिए. तो दीज थिंग्स आर वेरी इंपॉर्टेंट. एंड प्राइस टू बुक वैल्यू वी हैव टू सी कि कम है या ज्यादा है. कि कम है तो वी हैव टू बाई. So valuation multiple may we have no that P ratio, see price to earning ratio, price to book ratio. I told you already discussed here the formula that will help you to calculate if you have a company's income statement or profit and loss. So you should know how to read the company balance sheet. Balance sheet is given, you have to see the proper thing. If you have a formulas, like P ratio, what is that? Price per share for the beginning year and by EPS. Then price to book value ratio, price per share at the ending rate by book value. So these will help you to analyze. So going beyond the number, we have to know the size and situation, prospect, capability, order, regulatory, technological, marketing, distribution, financial accounting, human resource and personal. So evaluation of management is what are the strategy they are following, what is the integrity, what is the value of the company, what's the organization culture, what is the organizational structure, execution they are doing properly or not. Investors, who all are the investors? We have to see their EPS is year by year, it is increasing or not. We have to see. Second, what is the price earning ratio? Then we have to see company's asset is increasing or not year by year. So we should know about the current ratio. We should know about the liquidity ratio. Then we should know about the debt equity ratio. These are the very important. Then if you are a layman, you are able to buy any company share. You are able to invest in stock market because you should know, okay, asset will always day by day, it should increase year by year and liability should decrease. And every company should have a liquidity. Means the company is having a liquidity position. The meaning is that the company is having the cash. I'm talking about the big companies. For example, Tata. For example, IBM. They have a company's cash. Company is putting their money in their business and they are creating assets. But the company is having some cash. For that, we have to see the liquidity ratio. Now, estimation of intrinsic value. Key estimated the expected EPS, then P ratio, develop the value anchor. See, one more thing I forgot to say that the company's cash flow. That is a very important when I am talking about the financial statement, I am talking about the profit and loss account, then balance sheet, cash flow, income statement. Why cash flow will say about the company's cash position. Day by day, year to year company, how they are increasing their asset. Their cash position I should know when I will see the company's cash flow. So now here the EPS, how they will forecast. Here it is given. Please refer these slides. This is one example only for your reference. PE ratio again here, what the constant growth dividend model, how we are following PE ratio. So dividend payout by expected, how what is the formula. Then here ratios, again PE ratio. So fundamental, under the fundamental, the first thing is company analysis. Then we will talk about the technical analysis, what Michael Daw says, how Modigilani and Miller approach, how the approach. So that time we will see about that. So value anchor and value range, how you are able to projected your EPS and appropriate PE ratio. Then PV, price book valuation and return on equity matrix, how. This chart is very important. Here your private book value ratio in the y-axis and x-axis is your ROE. If high, see high and low. What is the meaning? If overvalued means low ROE, high PVV. Low though both will be, then it will be low. High when high ROE and high price book value ratio. And when it will be high, even undervalued. So you should know when the company is overvalued, when the company is undervalues. Growth duration metrics again, expected 5 years EPS, how to see undervalued, overvalued, promise to growth, and here it is dividend cows. So promise of growth. So expectations risk index ERI. How you can reflect? ERI will say about again the company's escalation route and future growth. See nowadays screener is there. In a screener if you go, type the screener in Google and if you put the any company name, what you want to do, you see there everything is given and you have do your analysis. But you should know about the 4 or 5 things what I discussed. Okay, first intrinsic value. You see your intrinsic value it is above that or lower that. So if you go in investment checklist, you are able to see that. There only you will know about intrinsic value it is upper than the value or lower. If it is more than the value, you should not buy. If it is less than the value, you will buy. So step by step you can go and you are able to see that. Here the several calculation is there. What are the obstacles in the way of an inadequate or incorrected of the data, future uncertainties. Okay. So in the summary, I can say all this whatever I discussed, but the main thing is my PE ratio, intrinsic value, PE ratio, your EPS, your price to book value ratio. So in screener you go, you type any company. If I will type ITC, for example, next class I will open the screener and I will make a class after next class. Okay, I will show you how you are able to see in the screener. And first you have to check the intrinsic value. Then how you can see that what. Okay. For that I will make a checklist. Key first is my intrinsic value. Then second will be my EPS. Then my PE ratio. Then my price to book value ratio. So I will make a checklist and I will make it. So I will buy that. Key first is what? Intrinsic value. Always the company value, whatever, that should be less than, if the intrinsic value is less than the value, then you have to buy. That is the first checklist. Then you check the EPS. Then how you, because otherwise how you will know if this stock will move over further or not. Then you have to do the fundamental analysis. After that you have to do the company analysis. Which company? So intrinsic value first is the foremost, then EPS, PE ratio, price book value ratio, debt equity ratio, and if you want to know company's cash position, current ratio and liquidity ratio. So these are the points I discussed today. So thank you for watching my video. Next class, please just tell me where I have to improve and what you want to know from me. So I will do. Thank you.